So the bull take is that rise in the unemployment rate, if it's basically fueled by young people, does not have the same relationship with spending and growth within the environment. And that group also doesn't spend very much money compared to other groups.
We just don't know what's going to happen next. And that's really increasing the political and economic uncertainty and makes it very, very difficult to run a portfolio.
There are known knowns, there are known unknowns, but there are also unknown unknowns, the ones we don't know we don't know.
Don't say that after you've been to the pub, that's for sure.
I would wake up at 3:45 in the morning and I would trek into work and sit in my office at 4:30 just to have the privilege to hear these gentlemen do what they're doing for free for all of the audience right now.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 28 of The Art of Investing, brought to you by IG, the global investment platform. We have a very special guest today, but first introducing my co-presenters, Mr. CJ Fellingham.
Hey, Rich.
And Mark Spice Holden.
Hi, mate.
I'd like to introduce Francis here. This is Francis Donald, Chief Economist at the Royal Bank of Canada, an absolute superstar in the economic world. Very well respected, and her time is asked for by so many people. She's asked for by CNBC, she's been on Fox News, she goes on all these things, and now she's had the ultimate in her career, appearing on this podcast, which we all know was voted best financial podcast in the UK by our listeners last year.
What's the secret? How have we managed to get Francis onto the show?
Well, Francis, myself and Mark worked together for a number of years at Manulife. We relied on Francis for our macro story, what's going on in economics, what's going on in all the stats that we were seeing. Where should we be ignoring things? Where should we be taking things on? What were the big themes? So we are so lucky to have her with us today. I'm really looking forward to this conversation. Before we say any more, though, Francis, after that, would you like to just say a couple of lines about your history and where you've come from and how you've reached this pinnacle of your career on this podcast?
Oh, that would be several pints for the whole story, but I'll give you the short version. So I've been an economist, macro strategist most of my career, but actually what a lot of folks don't realize is how many different types of economists you can be. There's not just one type. I worked on the more academic side for the Central Bank of Canada, the Bank of Canada, actually under someone you may know very well. Mark Carney was the governor of the Bank of Canada when I was there. I have worked in independent research shops, really selling macro research to hedge funds across the world. I have worked for banks in the past, and of course for asset managers alongside you, and now for a major financial institution, 8th biggest in the world, as the chief economist running a team. And one thing that I've always found interesting is how different those roles actually are, even though the title is the same. You know, when I worked in asset management, if you brought forward an idea that was already baked into markets or was consensus, if GDP forecast was 2% and you said, I think it's 2%, you would be fired. There is no money to be made in that trade. And yet there are different types of roles. For example, the role I'm in now, forecasts feed right up into the financial institution and are part of its own modeling and loan loss provisions. And so if you were to go and present a wildly out of consensus idea, you would be fired for that. And so the models, the way we think about the world, the data we look at is very much the same, but the end objective can change. And when I left asset management and I came back to the sell side, I worried it would feel a bit like a a little bit like a demotion, that I really wanted to be on the tip of markets all of the time. And what I've actually found is being able to speak to large companies across the world, from grocers, fast food restaurants, manufacturers, about what the operating environment looks like for them, about what it's like to hire people and how they're dealing with prices, has made me so much better at my job. Because instead of believing that the economy is operated by one single number like GDP, I now truly recognize that it is all the individual businesses and people across these economy that feed up into a number like that. And that's the thing I love most about this job, and why I will likely forever be an economist.
And it's really interesting you say that, because just as a little side note here, I used to find that as a fund manager. As a fund manager, when you had external clients, where you were running pension funds for some of the biggest countries in the land, you would go and present to them, but you would sit there and you talk to them about the real world and what was going on. You were suddenly taken away from the world of gilt prices going up and down 1/4 of a point, which to me was really exciting, but to them was not really that relevant, to actually understanding about the businesses. And it turns you into a much better at what you do and a much better understanding of how things work together.
And talking about being best at what you do, I would like to also highlight that Frances was voted one of Canada's most powerful women. Now, that is something that CJ aspiring to be on the Sunday Times rich list.
Yeah. Well, that's not going to happen.
Thankfully, Frances is more successful at that.
So wonderful to have you here, Frances. We are now going to go to the spice market update, since he's managed to get those headphones over those luscious locks. Mark, over to you.
Thanks, Rich. Well, it's been a week dominated by Trump headlines, just for a change. He's really put his foot down on the accelerator, and we'll come on to that later. But basically, there's also been a big return to geopolitics and people fretting about what's going on in Iran and Greenland. And more importantly, perhaps for equity markets, the earnings season has begun with earnest. So this week, we've had a lot of new all-time highs in equity markets. The laggards have again been sort of India and NASDAQ, which was what happened over Christmas as well. But other markets eked out new highs. Japan had a particularly interesting week because the new Prime Minister of Japan, Sanae Takanichi, has decided to call a snap election. And so that sent the yen down, the Nikkei up, and JGB's, Japanese government bonds, down a little as well. So the yields rose there. And those were the only yields to rise, really, in the bond markets this week. As I mentioned, we've come into the reporting season with earnest. The US banks traditionally kick this off, and they have been coming thick and fast this week. Goldman Sachs, Citigroup, JP Morgan, most of them beat forecasts, but the shares actually reacted pretty badly. And that's partly because Donald decided to throw them a hand grenade and say that he wanted to put a 10% cap on credit card interest. This theoretically is good, because obviously if you've got a balance on your credit card, you'd be paying a lot less than the 20+% that you probably do at the moment. But of course, it may lead the lenders to rein back a bit, because if they charge lower amounts of interest, they don't want to take as much risk. And so people who might want to use credit cards for higher risk purchases won't be able to get access to that. So it's a double-edged sword, but theoretically it's a great headline-grabbing policy.
Frances, what do you think? Caps on interest rates on credit cards?
Well, like all things Trump, let's see what the actual policy turns out to be. So we run a variety of scenarios, but he's talked about this being 1 year. And the first thing that comes to my mind is, okay, there's stimulus, and it's probably inflationary, which is not what President Trump wants. In fact, it looks like he's really trying to focus on affordability, and this could turn out to actually backfire on him. So another Trump policy where we have to get more visibility on what the end policy will be, and no shortage of financial institutions saying they'll fight it. So we'll see.
Something makes me think that's probably not the last time we're going to hear Trump mentioned during this podcast.
Yeah, well, he's obviously going to be a very big subject, but it's just interesting how a free market operator wants to make everything not a free market. I go back to comments I made before about being a real estate guy. He likes low interest rates. He likes gear in the balance sheet. And if it goes wrong, it's somebody else's problem. Well,
I mean, look, for equity investors, the two most important things are that their profitability on credit cards would go down if that came into power. And also the risks would go up because they don't have enough compensation in case of bad debts. And so as a result, Visa and MasterCard's share prices both fell about 4 to 5%, along with most of the other banks as well, the same sort of amount. So yeah, a difficult week for the US banks. But elsewhere, you've had very good results from companies like Taiwan Semiconductor and Fast Retail, who own Uniqlo in Japan. It's not been all good news, though. Saks of Fifth Avenue, which many of you will know if you've ever visited New York, finally went into Chapter 11. They missed a $100 million loan repayment, and so they've gone into Chapter 11. Now, Chapter 11 is a bit like going bankrupt in the UK, but it's not quite the same because you basically go into a period where you can restructure and continue operating at the same time. So you basically run your business for cash to try and get as much cash in as you can, pay down the debts, and then on you go again. If you manage to do that successfully, you're allowed back into the market, and you won't have had to sell many stores or whatever you have to do. But sometimes for competitors of those companies that go into Chapter 11, it's pretty bad because those companies tend to cut prices aggressively to get cash and business in. We used to see this a lot with airlines. Companies like Delta and American Airlines used to go into Chapter 11 all the time, and British Airways, poor old British Airways, would have to fight them on lower prices because they would basically run in their business of cash, and that hurt profitability for the whole industry. But Saks is gone for the time being. Anyway, we'll probably come back knowing them. On a positive note, though, we've had mergers and acquisitions. We've had basically Rio Tinto have re-announced their merger with Glencore in the UK. So that's helped the FTSE 100 this week and helped our BlackRock World Mining sort of position. Which
is that a new high for FTSE this week, Spice? Just wanted to get that in there before. I mean, it's not been caught up so far.
If it was I said lots of new highs.
Yeah, there we go, you see. But it's been very good, hasn't it?
It has been very good.
What it's not a new high for is Glencore, because I IPO'd it back at £5.30. And even after this bid, it's still below £5 some 14 years later.
So well done, Rich. Once again, don't follow Rich's investment advice.
Providing value.
On the day, it did help Glencore shares. I think they're up about sort of 7 or 8%. And Rio Tinto, because Rio Tinto are effectively reducing the quality of their overall business by merging with Glencore, their Rio shares were down a little bit. But overall, like I said, it helped the FTSE 100, helped our position in BlackRock World Mining, which is great news. And, commodities generally have had a fantastic week again. We'd mentioned last week that they'd finished the year very strongly, and that's continued into the new year with gold, silver, most of the platinum group metals, which if you remember is platinum, palladium, rhodium, all hitting new highs and shooting the lights out. Silver we've talked about things going exponential, where they basically go up in a straight line like a hockey stick. And silver this week in the last couple of days has certainly been showing signs of being exponential and has got a few nerves tingling around this table, I'm sure. So a great week for commodities, and things like gold was particularly helped along, and actually gold eked out that a new all-time high because we've had this return to geopolitics. Obviously, Trump has been threatening Iran, whether we've seen unrest and political protests, and he's been threatening to go in and maybe sort of use military action in the Middle East, which we know from the past is unsettling, particularly for the oil price. So the oil price actually moved up about 3 or 4%. And then last night, Wednesday night this week, he's reined back from saying that he wants to do that. And the oil price has come off a bit as a result of that. But, it just shows you that the world is still a pretty unstable place. And Trump is at the heart of it. He wants to be at the heart of all of these conflicts and trying desperately to get that Nobel Peace Prize.
Francis, we'll come on to the economics in 10, 15 minutes' time. But what about the geopolitical side of it? It's been a fairly volatile start to the year, hasn't it?
I work with a lot of traders. They'll tell me geopolitical risks are always a fade. And I think that's an interesting take because in the short term, that has historically been the case. But there are some seismic geopolitical moves that are occurring. And, Spice is talking about oil and energy. And up in Canada, we've been talking a lot about Venezuela in the last few weeks. It's really struck me that, there's so many conversations about what this means for how many barrels will be added back into the market over time. Markets want these events to move very quickly. But the nature of these geopolitical risks right now is that they are slow burns. And so it's complicated as an investor to figure out, do you price in that entire story right now? Or do you recognize that, for example, Venezuelan oil is going to take years, perhaps a decade to really start to meaningfully move the market? What is the timeline of your investment around that? And that's what's so different about particularly, President Trump's style of geopolitical actions is that the market wants them to move quickly and be impactful quickly. But really, they are so much more long-term and a little bit more nefarious in terms of how they impact our economies.
To me, I think, it reminds me of an expression by Rumsfeld, who basically said known unknowns. And he was the guy who first started talking about known unknowns and unknown knowns and all that sort of thing, which confuses me completely. But we seem to have now a huge amount of known unknowns. We know there's problems with Iran. We know the things are going on with Greenland. We know the things are going on with Venezuela. We know things are going on with natural resources. We just don't know what's going to happen next. And that's really increasing the political and the political and economic uncertainty, and makes it very, very difficult to run a portfolio.
I've actually looked up that quote because it is a great one to understand. There are known knowns, there are known unknowns, but there are also unknown unknowns, the ones we don't know we don't know. It's fantastic.
That's a great quote.
It describes markets so well, doesn't it?
Yeah, don't say that after you've been to the pub, that's for sure. Factually, what the market knows is that Venezuela produces less than 1% of the world's oil at the moment at a really good pace, as Francis says. It could take 3 or 4 years probably to get back up to sort of 3 or 4 million barrels, which is what they used to produce back in the 70s, 80s and 90s. But that's going to take a lot of time and a lot of investment, which is why the oil price reacted first up a bit and then started coming off after the Venezuelan announcement. But Iran is more pressing because Iran is about the third biggest producer in OPEC. They're pretty important, 3 plus million barrels of oil a day, 3% of the world's oil. If there were to be sort of disruption to the supplies out of Iran, it would have a material impact on the oil supplies potentially, which is why the oil price's first move was actually up a few percent on the back of that. As Trump reined back last night, which was Wednesday night, the oil price has come off as a result. And equity markets wobbled a little bit. They fell about 1.5% when Trump first made his threats to use military force. But since, as he pulled back, markets have recovered again. As we speak and record this podcast, they're doing reasonably well this morning. The futures are looking good for a positive US opening this morning. So the other stuff that is worth mentioning, obviously crypto, which has been sort of a very, very volatile asset, has had a steadier week. MicroStrategy, which is one of the biggest advocates and buyers of cryptocurrency, particularly Bitcoin, did well this week. And they said they were going to buy, they bought $1.2 billion worth of new Bitcoin, and Bitcoin rose about 7% this week. So the only places where we've seen a rise in bond yields has been in Japan, very small compared to the last few weeks. But that was on the back of the Japanese snap election being called.
Do you fancy up to £2,000 in free cash? Well, move your investment portfolio to IG and you'll get up to £2,000 cash back. Simply open a general investment account, ISA or SIP, by the 30th of January and get 1% cash back on your transferred investments. Your capital is at risk. This is for new customers only, and the offer is valid until the 30th of January 2026 on ISA, GIA and SIP accounts. Terms and conditions do apply. Well, that takes us perfectly onto the portfolio, because if we've had a good week in Bitcoin, then have we also had a good week in our VanEck crypto and blockchain ETF? Well, it looks like it. That's the top of the leaderboard yet again, CJ. So up 6.4% on the week there. BlackRock World Mining Trust, we trimmed last week. We cut that position in half. It continues to perform up 4.7% this week. And then gold and copper both up 2%. So it really is the commodities that continue to roar, helping the portfolio to be up 1.9% on the week and 16.2% overall. Spice, take us through the underperformers of the week, because the biggest one is yours.
I knew I'd get the hospital pass. Oh yeah, nothing to do with the miners. NASDAQ was down 1.4%. I mean, look, that's not a terrible week, is it really, in the overall scheme of things? India, which has been struggling in recent weeks because of the battle on tariffs with Trump, down another 0.5%. The S&P 500 sort of following on again, down about 0.5%. And our mid 250 in the UK suffering a little bit, down 0.4%. So those aren't big losses. And overall, a very good week's performance, up 1.9% in total. We won't sniff at that.
I think if you look at those returns, you can see very clearly they do split between the commodity sort of Bitcoin sector and the equities, with no real equity contribution bigger than sort of a half. If we said they're pretty much unchanged over the week, we've really work that through. So, it has been those commodities that have really helped us. And it's been very much a sort of wait and see attitude with regard to the rest of the portfolio. And I think that goes back to what Francis was saying earlier, and you were talking about the known unknowns. And the problem being that people don't really know what to do next. The uncertainty is extremely high. Is there going to be some sort of geopolitical announcement which causes the markets to set back 2-3%? Is Trump going to roll back? It's going to push the markets up 2-3%. What is the next thing? And outside of commodities, there doesn't seem to be any real generalized direction. I think that's recognised by the markets, because I think that means everybody's piling into commodities and thinks that's the only game in town. And we can talk about that in a moment, if we like, about some of the bubble-like nature of things, especially like silver. At the end of the day, we've got a lot of hand grenades out there and a lot of uncertainty. The big issue for me is to think about, once again, one of the big stories of last year, which was the US dollar and the US dollar and the underperformance of US markets relative to other markets. And we've seen marginally that this year, and that will be something for us to explore as well. It's not clear to me what the next sort of dynamic move is going to be. Francis, if I just ask you, and it's a question we like to ask our guests on the show, you've had a chance to look at our portfolio. What are you thinking when you look at it?
Well, not only have I had a chance to look at your portfolio, but I've also listened to several of the last episodes intently. I didn't even put them on double speed. I listened to them at 1.0 speed so I could fully absorb. And what's so interesting to me is that having had the opportunity to work and learn from you, Chris, is how little anyone and yourselves have talked about inflation risk. And I am worried about this, particularly after this week. And largely I'm worried about it because nobody is talking about it. So it seems to have dropped off of the known unknown list. And I don't even know that folks would categorize inflation as a known unknown, because they would say, what are you talking about? We have inflation data and it's been relatively subdued. Except we don't have inflation data in the United States. We have a muddled makeshift arts and crafts project that is the remnants of the U.S. government shutdown, where we've zeroed out a range of categories. We don't yet know how tariffs will filter through to the U.S. economy. And my sense is that there is much more inflation risk, and particularly it's a big fat right tail on my forecast for inflation than is currently being recognized by markets. And we have to keep this on the list of things that we're paying attention to, as much as we're thinking about what is President Trump's next move and what these geopolitical risks are.
And what would bring to the forefront that inflation? What would be the pressure? Which category?
So, and this might be a theme of my conversation, that inflation is still in the system. It's just not showing up in a lot of our data. And this is a huge problem with a variety of U.S. economic data and other data right now as well. We have 3 consecutive months of missed data. I still believe that goods inflation is going to rise in the United States into the second quarter of this year. Why? Because we are in the third inning if you're a baseball fan, or second period if you're a hockey fan. I don't know how cricket works.
I'm not sure we know how cricket works either, given the result in the Ashes. But just before you go on, when you say the third innings, how many innings are there?
I think we're probably like a third to a halfway through. Maybe that's the way that we should put it.
So for the people who don't get that sporting analogy, you're sort of halfway through that piece of the cycle is what you're saying.
Exactly. And part of it is that we are just really seeing inventory drawdowns in the United States. So we know that companies front-loaded huge amounts of inventory at pre-tariff prices. We know because when we speak to companies or we see in surveys that many of them really wanted to hold off on price increases until after the holidays to maintain market share. But the rubber's going to meet the road. Now, is it catastrophic? No. But think about it. We're flowing in the high 2s here around inflation. It doesn't take a lot to tip us back up towards 3%. Again, it's not 7, 9, 10%, but this inflation risk is probably going to creep back into the story. And I think we're going to need to monitor that really closely.
But do you think, Francis, that would lead to expectations of interest rate rises, or just a delay or a cancellation of potential interest rate cuts in the US?
Well, first, it's a process, but cuts are going to be really challenging in this type of environment. And here's the challenge, we will have central banks that have to talk around it. And, when I was coming up in the business, most of what we would do is we'd say, here's the inflation forecast, and therefore this is what a central bank would do because this is what a central bank has always done with this particular economic outlook. But the challenge moving forward is, the data is easy to talk around. So, for example, there are components of inflation that we know are really poorly measured, like rent and shelter. And so we already hear central bankers who will say, well, just ignore that category. We're going to focus on these ones. Or if you wanted to make another argument, you say, no, we can't ignore that category. Mm-hmm. And then, of course, we have biases. And while there have always been biases at central banks, so some of you may know that for forever, we have called central bankers doves or hawks. That's a bias that we're trying to speak to. Those biases might become larger in 2026. And so probably the first step is to say it will be very difficult to cut rates, but there's going to be a portion of this market that maintains a view that the next Federal Reserve chair is going to have a very substantial dovish bias. So it's my least favorite part of the job is Fed watching, reading speeches, checking to see what color tie the Federal Reserve official has on and trying to come up with some sort of outcome. But it's going to be, unfortunately, increasingly necessary because it's my view that the relationship between the economic forecast and a very clear Fed call is going to break down.
Can we just take that a little bit further in for a second? I mean, first of all, anybody who saw the camera there would see me sniggering because I think in one of our earlier podcasts we talked about the bulls on inflation are the people who tend to say, if I take out everything that's going up, inflation's performing really well, which is what you're saying with the rent there and with other things. But let's go on a little bit. We've got the tariffs there, but we've got this thing called the Big Beautiful Bill, and my less follically challenged person opposite me, the Buffon gentleman,
you can't call him a buffoon.
Not buffoon. He's talking about the Big Beautiful Bill all the time as being, the one thing that's going to really make it all rock for the US and still have no inflationary problem. So, what do you think about that? What do you think about that?
The short answer is, well, it depends who you are, because there's a growing issue in the United States where we have headline growth and we have headline inflation. And for most investors, that is particularly if you're a macro investor, you're buying indices or you're buying general bonds and you're making a call on what that CPI or PCE number is going to be, that's the most important thing. And the OBD combined with other forms of stimulus that are already in the system, those will be supportive of growth. Productivity is creeping into these numbers and probably also having an impact on growth that isn't yet in the numbers that will produce higher GDP numbers this year. And so investors are going to clue into that. The problem is this growth is very uneven throughout the United States. And so if you're picking sectors or individual companies in the United States, you have to be really careful about extrapolating a high GDP number to mean that's true for everybody. For example, when we talk about inflation, I could make the argument that if you strip out owner's equivalent rent, inflation is just fine. However, food inflation is spiking in the United States. We just had a big food inflation number. It's the highest it's been in 2 years, and all leading indicators tell you food inflation is starting to rise. So what does that mean? Well, it means that lower and middle income consumers in the United States are going to be bit more substantially by the type of inflation in the system, and their consumption will pull back. Now, I've heard you talk on this show about the K-shaped economy. I think we should talk more about that. There's some really interesting elements. The idea, of course, that the top 10% of Americans spend 50% of all of the money in the system. Now, if you want to be a bull, this is great news. You have effectively untouchable 10% consumer that is carrying the weight. And I got to tell you, if you look at the financial assets acquired by, it's really not the top 10%. It's really more the top 1%. Even a 20, 30% pullback in the S&P, that brings them back to where they were last year. Like, it's so inconsequential, even a pullback to that extent.
Oh, really? So you don't think this wealth effect of asset markets is what continues to drive it, even if we see a pullback, that it doesn't destroy their confidence, the ego even, that they continue to go out and spend as much as they have?
I don't think it will derail the U.S. economy. The wealth gains that we have seen are so substantial. Now, there's a second element to that. We're tangenting here, but There are two groups that I think are really sensitive to that stock market. The first one is the one that I think is very resilient, which is, the ultra wealthy. They're largely retired, and they don't have sensitivity to what is happening in the general economy. And there's another group, though, that I think is very sensitive to the stock market, and those are what I call the almost retireds. The almost retireds, if you did see a pullback in the stock market, would probably work longer. Now, you might think, how many folks are almost retired? A massive amount of Americans. 1 in 5 Americans is over the age of 65, and we have record amounts of retirements happening in the United States. 2.2 million Americans on a rolling 12-month basis. It is a hockey-shaped acceleration in the past 18 months coming from this stock market gain. And so you asked me a simple question, but really the tentacles of it flow through, because when you have this huge amount of retirements that are coming from a stock market gain, one person might say, well, that's actually good. The stock market is contributing to a resilient consumer. But what it's effectively doing that very few people talk about is it's taking people out of the labor force. And that is core. The tenets of one of my most important U.S. views is America needs workers, not jobs. And so when people talk about, well, what would a pullback in the stock market do? Would that sink consumer spending? That's not the question I'm asking. I'm thinking if a pullback in the stock market results in fewer people retiring, which is a huge issue in the U.S., that's the biggest implication for consumption in the U.S. right now.
Francis, can we just step back a bit? Because you are really one of the leading experts on doing this work on structural changes versus cyclical. Could you maybe explain to our audience, what does it mean when we talk about structural changes? And one of those being the demographics that you've been doing a lot of work on.
Well, thank you for implying I'm a leading expert. This is not intentional. It's actually because there's no real choice. So look, if you ask me to step back a little bit, one of the core goals for my entire career, being hired as an economist or a macro strategist, working with portfolio managers or supporting their the art of their investment, was effectively came down to one question, which is, where the heck are we in the cycle? Are we early, mid, or late cycle? And we have a whole toolbox of ways to gauge that. We could look at, for example, wage growth. We could look at consumer confidence. There's a whole toolkit of things that would give you leading economic indicators of where you were. And the investment recommendations that would come from an economist or a strategist were very much based off of, are you rising out of a recession? Are you in the middle? How many years do you have until the next recession? This was the game for decades as an economist. Now, in 2022, you may remember, I certainly remember, 100% of economists surveyed by Bloomberg called for a recession in 2023. Does anyone else?
Oh, yeah.
That was there, definitely. No doubt about that.
Okay. So 100% of economists called for a recession in 2023. I remember it very clearly. I'll share this personal story because in August of 2022, I was 9 months pregnant and I knew I was going to be offline and I knew I'm going to have to make a call and shut my computer and I'm not going to be able to access it. And I had so much conviction that there would be a recession in 2023 that I thought I can go out. And also, just as an aside, when you're an economist, you're going to call a recession. It's a very big deal. You got to bring it all the way up to the CEO. You got to warn your comms team. You got to make sure it's not going to imply something for your stock price. I mean, it's a really big deal to do this. Your whole career, your reputation internally, externally is called on this. I was so convinced that I went all the way to the top, called the recession. I said, I'm going to go have a baby. I'm going to raise that baby a little bit marginally. I'm going to come back and there will be a recession. Unfortunately, I did indeed have that baby. I did come back. And I came back absolutely exhausted to no recession. And I have spent every waking minute since 2023. And because I now have 2 children, that's a lot of waking minutes, obsessed with why the heck did that happen? It happened because that toolkit, which we had relied on for decades in my profession, broke. And economists in general have just swept this under the rug. They're like, don't talk about that. Like, just brush that to the side. And problematically, we still have huge swaths of economists who are still using that toolkit. Oh, 2023 was different. I don't believe that. I think in 2023, we had a moment where many of these structural themes started to take over cyclical themes. And the bulk of my work with my clients has been to help explain to them that this concept of early, mid, or late cycle is done. Maybe not forever, but at least for the next several years. And so instead, particularly in an environment of really large uncertainties, our job is to say, what are the core themes that will be sticky and permanent and irreversible or only marginally impacted by whoever is president at the time? And this has served my career, but also my clients so much better than looking at something like an ISM index or even the unemployment rate and saying, this is how you should invest, risk on or risk off. I just don't believe that that's the value of the Economist anymore. So it's not that I suddenly stopped caring about tactical markets. It's not that I thought, oh, I just, long-term things are easier and I can take longer to write a report. It's that I believe the game has changed and the profession has to change with it.
Frances, what would you say are the new two most important things to look at then to decide whether it's risk on, risk off, or where we should be thinking?
I'm going to take a different angle from that. I'm going to say, here's what you shouldn't look at for risk on or risk off. The first is the value of the unemployment rate is changing very dramatically. And this used to be one of the most important indicators that you would look at. It's changing because the supply of workers is shrinking very dramatically. So historically, we would use the unemployment rate. If it's rising, then people are losing their jobs, they're losing income, and therefore you need to be risk off. And if it's falling, it's the best indicator that folks are gaining jobs. It's an example that there's a lot of demand for workers within the system, and they're going to have more income, and therefore you can be risk on. But because we're in an environment where the labor force is shrinking dramatically, and it's shrinking it's exacerbated by immigration, but this is really a demographic story as the population ages. I was going to say very rapidly. We all age at the same point, but the cliff of those over the age of 65 we're just hitting the beginnings of that cliff. So what's happening in the United States right now is you have 3 retirees for every 1 unemployed new entrant coming into the market. So I'll just say that again. There are 3 retirees for every 1 unemployed new entrant in the United States. This is empirical. We can measure this. And so when you talk to companies, as I do across the US, grocers, telecoms, they may say things are a little soft for them. And I'll say, why aren't you laying off workers? And they'll say, Frances, we don't have to. We just wait.
Wow.
We don't have to get legal involved. We don't have to pay out packages. We just wait. Why is this so critical if you're an investor? Because when folks retire, they don't go collect unemployment insurance. They don't show up in something like jobless claims. They go off and actually increase spending because they're dissaving. So we're in this low hire, low fire type of environment, and it's a demographic story that's coming into play. So we actually have the unemployment rate in the United States peaking at 4.5% this year. There's only 2 times in history when the labor market has been this tight, like in modern economic history. That's not because we think the U.S. economy is booming or the labor market is on fire. It's because we know that there will be a shortage of supply. So we talked a little bit about inflation earlier, and one of my concerns is that when you have a labor market that is structurally becoming much tighter, wage growth is not going to fall as much as people think it will or has in past cycles. And that's going to put some inflationary pressure ahead. So number one is how we think about the labor market changes. The second one we've already talked about, which is we have to be really mindful about how we monitor the consumer because there are so many subsegments of consumers in play. We have the ultra wealthy consumer, and then we have the rest. I will say I'm on a bit of a mission right now, which is that a year or 2 ago, I loved the concept of the K-shaped economy because nobody seemed aware that this fragmentation was happening. I now think it's far too simplistic because it's not just about the ultra wealthy and the rest. It's in part different segments. So we've got millennials who have student debt and housing debt, extremely interest rate sensitive group. We have those under the age of 24 who have a surging unemployment rate. I think that's an AI story. And then we have the bottom 10% of Americans. And the problem with the K-shape is that folks will say the weakest Americans, the poorest Americans are suffering the most. And that's true in the sense that they have the most amount of income that goes towards food and shelter. But our analysis actually suggests they're not doing as poorly as other groups because they are substantially supported by government transfers. And government transfers are inflation adjusted, and they are not cycle dependent. They basically lead to an environment where the United States right now has one of every $5 of income that comes from Social Security transfers and government transfers. One in $5 of income in the United States is coming from Washington into the pockets of Americans. It's, again, inflation adjusted and recession resistant. So incomes in the United States right now are no longer following the path of the business cycle. And what are people in America spending on? They're actually spending 22% of all of their money on healthcare. 22% of all American spending is now going towards healthcare. It doesn't have a cycle attached to it. It is purely a demographic story. So when you say, what should we be watching? My main point here is that the American economy is shifting so quickly and dramatically towards acyclical, in some cases, inflation adjusted types of income and spending that really mean the business cycle gets compressed. So using these traditional indicators failed us in 2023. And if you are still using them, you are still calling for a very weak economic outlook that is just not being matched with GDP numbers. So to me, sure, there's a lot of productivity in the system, but it extends so much farther than that.
You mentioned AI in there and its effect. How easy is it to spot those trends in the unemployment data of those various groups with the AI effect as well? I mean, because that's adding quite a lot of distortion, isn't it?
It's very early, and economists are in general not very good at measuring things like productivity gains that are coming through. But here's what we can see. We have seen significant, but not the entirety of growth in the United States driven by physical investment, like building the actual data centers and information processing equipment, hiring people, shovels in the ground, build out the infrastructure. And this is not just driven by AI, frenetic euphoria. It was substantially driven by a very specific Biden policy called the CHIPS Act, which produced massive incentives to go out. And so the CHIPS Act sort of front-loaded a lot of economic investment into AI. And sometimes I see charts like, oh my gosh, we're investing more in AI now than we were during the internet bubble or other forms of industrialization. Some of that is coming from government incentives that are still in the pipeline, by the way. And we have more of that coming through with accelerated depreciation. So it's not apples to apples. We know it's sort of tipping over a little bit now. And so the question for 2026 in our work was, does that physical investment now hand off to productivity gains? And importantly, from an economist perspective, we're looking for, are those productivity gains not just creating benefits for the Mag 7 or AI companies, but are they filtering down into other sectors yet? And the big one, per my earlier comments about 22% of spending going into healthcare, is how does AI transform healthcare? This is going to be huge for the U.S. economy going forward, and basically will speak to whether or not these Western aging economies can actually support people. But at the same time, we know there are tentacles of the AI transformation. I talk to a lot of automakers. What is the future of autos in an environment? Has anyone here gone to LA and driven in a Waymo?
My friend's just been to Texas, and exactly quite an experience. Sent me a video of it as well, and I'm not sure I'd have the guts to do that yet.
Feels very exciting for the first couple of minutes, and then after that, you just end up like back on your phone scrolling your social media because you're just in a car going somewhere. So we talk a lot about those sorts of tentacles. What does this mean for healthcare? But in the back, what is worrying me is for a decade, even before we saw ChatGPT come forward, I would stand on stages across the world and I would get asked, what jobs is AI going to steal? And we all had these charts by sector. So we'd say, finance is going to lose this many jobs and healthcare is going to lose this much. But I don't remember a single person over that time saying it's not going to be a sector, it's going to be an entire demographic. Mm. And what we're witnessing right now is the unemployment rate in countries across the world for those under the age of 25 is surging. very dramatically. So when you hear about these no fire, no hire economies, which are, again, something that's happening in a lot of Western economies, the no fire part, we've addressed that. That's in part, you don't need to fire people, they will just retire. But who's implicated the most by no hire? It's young folks graduating college. So here's the bull take. Because, Chris, you always struck me as like, well, give me the bull take on this. So the bullish take is, this is great. Because
he normally goes bearish, actually, Francis.
Yeah, I don't know. He's like a positive, happy person in general, though. So I want to give him the optimistic side.
how he's changed.
It's been a few years, has it, Francis?
The bull take on this is that when you graduate college and then you want to go get a job and you can't get a job, you satisfy as unemployed. What's not happening is a lots of income. Well, maybe for your parents who are still going to be supporting you, but you are not going from making, $200,000 a year, losing your job and not being able to pay for it. And that group also doesn't spend very much money compared to other groups. So the bull take is that rise in the unemployment rate, if it's basically fueled by young people, does not have the same relationship with spending and growth within the environment. The bear case is that this is probably a large socioeconomic problem that will need to get addressed in other ways and is likely to create a lot of chaos and resentment, very reasonably so. What I don't know yet is this slow hiring of college grads a pause because there's so much uncertainty, because folks don't really want to fire, and it's just sort of a temporary hold saying, well, let's not bring in junior, almost like a global hiring freeze that naturally sort of pauses that group? Or is it a very explicit policy around let's test whether those junior roles can be replaced by AI? And the companies that I talk to, some of them feel that that's true, and some of them test it and say, no, we actually need a person going forward. But it's another reason why it's very easy to look at something like an unemployment rate, go across your screens. Maybe you're watching financial news and you hear the unemployment rate has risen. That may not necessarily carry the same implications that it has historically if it's really biased towards young people. So here's a data point you should watch, which is when jobs come through, what is the demographic of it? And I've never looked at that in my entire career, but now it's the first thing that I look at.
Yeah, I think it's fascinating, actually. And one of the things that I was talking to my daughter, who's just qualified as an architect, and we were talking about the implications of AI, and a lot of the lower sort of experienced jobs in things like architecture are being replaced and are going to be replaced by AI. The question comes in a few years' time when you're out of the more experienced people. How do you get them back into the system and how do you get them to work? And I think that's a major question for most companies because it's all very well. I think the financial benefits of companies not hiring young people at the start will be good for productivity, good for profitability, good for share prices, all the rest of it. But the problem could come in a few years' time, I think.
There's other elements to that too, which I think Spice made a great point about productivity, which is the demographic story is also relevant because it turns out that on average, the older, I'm going to choose my words carefully here, given the podcast host.
The age of people around here. I think that's very good advice, that. Choose your words carefully.
Experienced workers tend to have higher productivity levels on balance than less experienced. So as your workforce ages, you do have higher productivity just mechanically. If the average age of workers is older, you have higher productivity. And that's not because every individual person got suddenly more productive or had more resources. It's just because they've acquired knowledge. So I might say that Chris Fellingham has higher productivity than I do. That would on average be true. Now, when he eventually retires, which seems a long way off, if he's replaced by somebody much younger than him, I think I'm doing great at this podcast. I would be a good candidate. At that point, the productivity of the show would probably drop. And these are mechanical. And that's why productivity is such a really difficult thing to measure. And we just have to be cautious about really broad extrapolations.
It's probably a good time to mention, actually. So CJ is off to San Francisco in a few weeks' time. On the topic of hiring the younger labour force, we are looking to replace him with somebody of equal value add for that week. So if you do have any young kids looking for work experience, do write in and let us know.
Oh, how harsh on the chairman of this organisation that's performed so well. The responsibility that's all been mine, but I can live with it. I can live with it, Rich. I had another area that I wanted to explore with Francis, and that is the approach to Donald Trump.
Mm-hmm.
So we live in the UK here. We have Keir Starmer, who is always agreeing with Donald in whatever Donald does, is restrained from criticising him, and is making sure that we stay in his good books. Whereas you in Canada have a certain Mr. Carney, who we clearly know quite well from here. For those of you who don't know, he was governor of the Bank of England at some stage. There are a number of views on the effectiveness of him in that role, but we'll leave that one for another day. What's it like in Canada now with a prime minister who is taking it to Donald?
I don't know that the perception within Canada is that is what the prime minister is doing. Or I should say the response in Canada to the initial trade war, which was, as an aside, absolutely shocking to Canadians and economists, visceral. I mean, you still to this day, if you mention that you are heading to the United States for a personal vacation, you should wear a scarlet letter. People are secretive about whether or not they're going to the U.S. for vacation, truly. And there's been like a 30 to 40% drop in trips from Canada to the United States. I mean, Canadians were so substantially offended that there were huge amounts of Canadians who refused to buy American products. I had one client who's a office supply store, and they told me they had to dedicate like 100-person team to going line item by line item to look at highlighters and paper packs to see what actually qualified as buy in Canada. And there were stickers in grocery stores across the entire country. This is made in Canada, or specifically, this is not made in the United States. There was sort of a very organic, from the floor up type of frustration and insult that hit Canada very widely. What's interesting is I spend a lot of my time explaining to Canadians that while they are perhaps right to be offended by what came through in the past year, the economy has weathered this so-called trade war extremely well. And what gets lost is Canada was the first victim of protectionist policy from America. It was about 1 year ago, February 1st. It was also my husband's birthday. I had promised him a nap and that I would make dinner, and neither of those things happened. It was a Saturday morning when President Trump announced 25% across the board tariffs for all imports from Canada. And so we ran so many scenarios. I remember the weekend, you got to talk to everybody from policymakers to CEOs. What is the impact on the economy? It was terrifying as an economist, in part because we didn't know how to do it. We had no historical precedent. And we had no idea how the currency would respond, what the Bank of Canada would do, what governments would do. So we just created scenarios. Here's 8 scenarios of plausible outcomes. And one of them was a 3-year-long recession with unemployment at 10%, which in my mind is more like a depression.
Wow. Yeah.
And I felt like a doctor who had to give a cancer diagnosis because I thought, I don't want to say that this is a possible outcome, but it is a possible outcome. So businesses across the country prepared for what was within the plausible realm of outcomes. But on April 2nd, Liberation Day, you may remember it, President Trump stood in the Rose Garden with a billboard of 186 countries on it. And we were sitting in our offices trying to zoom in saying, where's Canada? Canada was not on the list on Liberation Day. And so on April 2nd, Canada went from being the largest victim of American trade policy to its smallest victim of American trade policy. Canada has the lowest effective tariff of any of America's trading partners. And the reason is because this giant free trade agreement known as USMCA, or in Canada we call it CUSMA, CUSMA, USMCA has effectively meant that 90% of trade from Canada is tariff-free. That trade agreement is still in place. So the bluster that we heard from Washington, the global perception was that Canada was being assaulted by this massive trade war, when in effect there's three sectors that were hit: steel, some autos, and a little bit of aluminum. And just because I know you love metals, aluminum hasn't even pulled back very substantially because Americans haven't been able to replace it at home. They have not actually been able to do that. Why aluminum, also known as congealed electricity, requires massive electrical grid usage, which the U.S. does not have. Why? Because it built 5,600 data centers. So what happened over this period, and I can tell you, I went to London, I've been to New York to see clients, and something very fascinating started to occur, which is while I was at home holding the hands of my clients and my fellow Canadians to say, listen, we're going to be able to weather this. It's going to be okay. The Bank of Canada has cut rates substantially. There's a lot of government money that's coming through to support these sectors. I would travel the world with my US chart pack, because if you go to see hedge funds in London or New York, they're not trying to invest in Canada. And halfway through the meeting, they would sort of close the U.S. chart pack. They push it aside and they say, you're the chief economist for RBC, which is the Royal Bank of Canada. Can you tell us about Canada? And they would say, because we're looking for ways to navigate this global trade war. And when we run sort of a dashboard of all the investable countries, Canada seems to actually have the lowest effective tariff rate. And then at the same time, we're thinking about what the world will need in 5 to 10 years. There's this global trade. What is the world going to need? It needs critical minerals, uranium, energy and electricity, food, water, and access to the Arctic. And guess what country has all of these things? It's Canada. So globally, I would travel around and people would say, it just seems to us like Canada is one of the most interesting, investable global. It's a G7 economy. It's got a relatively stable political environment. It just seems to have like this is a massive opportunity. And you have a new prime minister who has said, we're going to get all that stuff out of the ground and sell it. And we're going to go through with a massive budget similar to Germany. So we've been in this really interesting situation where foreign direct investment is piling into Canada. The stock market has outperformed the U.S. market this year, and corporate profits are roaring in Canada. And yet folks think that we're still under the weight of this massive trade war.
I think that's really, really interesting because someone like myself, and I regard myself as reasonably in touch with what people think, would not be saying and thinking exactly what you're saying there. So that's been educational for me, without a shadow of a doubt, on how Canada's actually dealing with the Donald.
Well, I'm more interested in looking up the IG platform and seeing if we've got a Canada ETF.
Yeah, well, perhaps that's one we've missed out on. We've got all this US holding. We could have had Canada. Was there anything else on that? Because I've got one last question. But
well, I was going to say, I mean, bring it back to sort of assets and potential asset performance going forward. From what you've said, trying to bring it together, you think that everything that's going on will lead to, with demographics, AI, etc., will lead to slightly higher than expected inflation, but a sort of flattening of the business cycle. Is that fair? A very fair assumption or not?
Yeah, so that is for the aggregate economy, you will see a flattening of the business cycle because 1 in 3 jobs in the United States is now government, healthcare, education, and spending is biased towards structural themes. Now, does that mean you won't have a private sector business cycle underneath? Of course not. And one might even argue that the private sector is the tail end right now and actually decelerating. But on average, these traditional concept of the U.S. business cycle, I think, is very muted.
So if you've got less of a cycle, that has to be good for valuations and the predictability of earnings of companies in the main, because you don't have these big cyclical swings. So you can afford to pay for a higher valuation in markets that are benefiting from that. And a little bit of inflation, as we know, is actually a good thing for equities because companies need to be able to put up prices, and deflation is the equity's worst enemy. So if I'm pulling it together, I'm trying to think that actually it makes me more bullish on equities, actually, ironically.
It's funny.
I did call it without all the blurb.
But actually it probably makes me more bearish on bonds, because if there is this inflation around that may pop up and scare a few people. But the irony is it also helps commodities, because commodities are seen as a bit of an inflation hedge, real assets, all the rest of it. So our portfolio should be well positioned.
I'm going to give you the most bullish argument here.
Oh, come on, Francis. Yes, please.
Okay, here you go. So because we are seeing mass retirements and a collapse in the labor force, the amount of jobs that the U.S. economy needs to create this year is collapsing. So in the past 2 years, you need to create hundreds of thousands of jobs per month just to satisfy people who needed jobs. We call this the break-even employment rate. We now calculate that that number is 40,000 jobs per month. The U.S. only needs to create 40,000 jobs. And actually, our estimate is probably, we were conservative, it's probably even lower than that. And so what's going to happen here is job creation is going to slow. It's already slowed meaningfully. For example, since Liberation Day, the U.S. economy has only added 11,000 jobs per month on average, but the unemployment rate has ticked up 0.1%. Effectively, what's happening is you no longer are going to have to create any material jobs in the U.S. for the unemployment rate to stay stable. And that means the bar to the economy continuing to grow is falling. And that's the most bullish take. And I just want to mention, I know this group loves metals. The TSX is very heavy on metals. And just another note here, I'm not advocating for a trade. I'm not allowed to do that. I'm just highlighting that the TSX is up 46% since Liberation Day.
Yeah, I've just looked at the chart on IG and it is absolutely gangbusters. Beautiful chart.
So just a reminder here that Sleepy Canada, which has the global perception of being the victim of American trade policy, has actually in many ways weathered this in incredible ways because it's tilted its focus to how do we be at the center of the new world order that's coming through. And if the country is successful, it's very bullish for Canada with a big italicized if.
But presumably, just trying to give the other view just because we're living in an even world. It's not quite the BBC here, but, we're trying to give both sides. You're going to find that paying debt back is going to be almost impossible because your amount of people working is actually not increasing particularly at all. And yet you're having to pay more and more budget deficit back, more and more subsidies back. All these people, as you say, £1 in £4 is coming from the government, £1 in £3 is coming from the government. So isn't that going to cause more of an issue with regard to this competition for capital, the risk-free rate, which is then going to fight against the bullishness of the equity markets?
Depends on your timeline, because that can be sustained for a period of time. And I might also say, it wouldn't surprise me if governments start thinking about different approaches to taxation. So if you have this kind of collapse in income tax, where should you be going? Is it wealth transfer taxes? How do you sort of approach this? Or are you just relying on growth to generate additional income for you as a government coming through? But you're getting to the core of this, which is that governments are getting bigger. I mean, one of my big macro structural themes, I call it forever big government, because we're not going in the opposite direction. We're going in a direction where demographically you will have greater and greater reliance on government transfers coming through. That's why I say $1 in $5 of income in the United States is coming from Washington into the pockets of Americans, similar in a lot of other countries. This changes the entire dynamic. And so the most important question to me is when does this run out? When does Social Security run out? Because the pressure on the government, the pressure on Washington is not going to come from the population saying, oh, well, we need sustainable debt levels because we understand the bond market. It's going to come from we have to make cutbacks on Social Security.
Traditionally, and, the whole conversation has been that maybe you shouldn't rely on tradition, that things are different. But traditionally, that only ever comes with a crisis. The only way governments spot what the right way forward is when they've tried everything else and it doesn't work. And the first thing they're going to do is just give more money away and try to hope it'll last for another 3, 4, 5 years till they've finished their turn at the wheel. And at some stage, therefore, there's going to have to be a crisis, which will then lead to, as you say, Francis, consideration being given to wealth transfers, universal income, all these other wonderful socialist ideals that, turn my blood to boil. But actually, at the end of the day, that's where we're all going to head.
Well, I think...
Wow, great. Fantastic. Thanks for that.
on that note, on that cheery note, that is unfortunately about time we're going to have to let Francis go. Francis, thank you very much for joining us today. It's been absolutely fantastic. I'm still trying to work out whether we're classifying these guys as retired or semi-retired. I think with all the Botox that Spice gets, then it definitely falls still into semi-retired.
I'm just going with experienced.
And wise.
Thank you, Francis.
And before we sign off, can I just tell a little story about these gentlemen that I think your audience needs to hear about?
Oh, that would be welcome.
Sorry, is that the time? I think the line's going now.
I want your listeners to hear something from me, which is that I had the opportunity to work with these gentlemen for several years. But back then, there was no podcast. Instead, there was a Thursday morning meeting, which was 9:30 London time. And I wanted nothing more than to hear these gentlemen talk about markets. This, to me, was going to be the most premier experience that you could have. And so I sheepishly asked them when I'd be able to dial in. And they said, this would be at 4:30 in the morning, Francis. And I said, I don't care. And so for 2 years of my life on Thursdays, and this was before work from home, I would wake up at 3:45 in the morning and I would trek into work and sit in my office at 4:30 just to have the privilege to hear these gentlemen do what they're doing for free for all of the audience right now. So one of the greater joys of my life is I no longer have to wake up so early. I can listen to this podcast regularly. But this is a true gift to your listeners. And I just wanted to say thank you to all of you for putting on this show, because it is some of the most premier investment advice that you can get. And it's a real privilege to be on with you today.
Thank you, Francis. The $10 Canadian will be in the post and on its way to you.
So that's it. No changes to the portfolio this week, despite an argument at breakfast on how we are wondering whether it's time to get a little bit more cautious. But of course, the bull wins through yet again. Join us next week to find out if that was the right move.